Welcome! Today, we're diving deep into one of the most fundamental, and honestly, one of the trickiest chapters in your GST syllabus, registration. This is where it all begins, and trust me, it's where a lot of easy marks can slip through your fingers if you're not paying attention. So, let's crack this thing wide open.
All right, take a look at this question. On the surface, it looks pretty simple, doesn't it? But this right here is a classic ICAI exam trap. So many students get this wrong. Do you need to register? Do you not? What's the right answer? Stick with me, because by the end of this session, you'll be able to answer this without even blinking.
We're going to follow a little story about a guy named Arav. He's facing this exact problem. By solving his real-world case, we're going to master these concepts for good.
Okay, first things first. I want you to think of GST registration as your entry ticket into the entire GST world. Seriously, without this ticket, you're not even in the game. You're basically operating outside the legal system, which is not a good place to be. It is the single most fundamental requirement.
So why is this ticket so important? Well, for one, it makes you a legally recognized supplier. It gives you the power, the legal authority to collect GST from your customers. And here's the big one. It allows you to claim input tax credit, or ITC, on all your business purchases. That is the heart of GST. And one last crucial point to remember for your MCQs, GST registration is PAN-based, but it is granted state by state. So you can have one PAN, but multiple GST registrations if you operate in different states.
All right, before we get into the heavy calculations and all the limits, we need to make sure we're all on the same page. We need to speak the language of the GST Act. So let's quickly run through a few key definitions that are going to pop up over and over again. Getting these right is half the battle, I promise.
First up, an agent. Pretty straightforward, right? This is just anyone, a broker, a commission agent, you name it, who does business on behalf of someone else who we call the principal. Simple as that.
Now, this one's important. Place of business. The key word here is includes. Whenever you see that in a definition, it means it's super wide. It's not just your shop or your office. It could be your warehouse, your go-down, even the place where you just keep your account books. It can even be a place where your agent is working from. So think broad.
And just to complete the picture, here are three related terms. A fixed establishment is basically another location, like a branch office that has some permanence. The principal place of business is simply the main address you put down on your registration form. And a registered person, well, that's anyone who's gone through the process and is officially registered. Easy peasy.
Okay, let's get to a really crucial concept now. The entire GST law revolves around something called a taxable person. Only a taxable person has to pay GST. So figuring out who fits this definition, that's the absolute core of this whole thing. This is where it starts to get serious.
And here it is. This is a 5-star, important point where marks are lost all the time. A taxable person isn't just someone who is registered. It's also someone who is liable to be registered, even if they haven't actually done it yet. That little word "or" is so powerful. It means the law can come after you even if you forgot or chose not to register when you were supposed to.
Okay, so the law says this liability kicks in when you make a taxable supply. But there's a catch. It has to be in the course or furtherance of business. So that immediately leads to the next question, right? What in the world does the GST law consider to be a business? Let's find out.
Wow. Okay, just look at how massive this definition of business is. It's huge. It covers pretty much everything you can think of. Trade, profession, manufacturing, anything. But look at that third point. An activity is considered business even if there's no volume, frequency, or regularity. That's a game changer. It means even a one-time transaction could be considered business under GST. So never assume something isn't business just because you only did it once.
All right, we've got the vocabulary down. Now let's get to the main event, the part you've been waiting for, the numbers. We're now diving into Section 22, subsection 1, which lays out the exact turnover limits that tell you when you must register. This is where we're going to solve Arav's problem.
So the law gives us three main tiers. For most states in India, if your total turnover in a financial year crosses 20 lakh rupees, you have to register. This applies to suppliers of goods, services, or both. For a few special category states, that's Manipur, Mizoram, Nagaland, and Tripura, that limit is cut in half, down to 10 lakhs. And then we have a higher limit of 40 lakh rupees, but, and this is a big but, it comes with a very specific condition.
Okay, exam tip. Pay close attention here. This is a favorite trick question from ICAI. That higher 40 lakh limit,
It is only for people who are supplying exclusively goods. The moment you supply even 1 rupee of a taxable service, boom, that 40 lakh limit is gone and you drop back down to the 20 lakh limit. But wait, there's a twist on top of this twist.
Now check this out. The law itself gives us this amazing explanation. Earning interest from a bank deposit is technically an exempt service. So logically, you'd think that would disqualify you from the 40 lakh limit, right? Wrong. The law specifically says, for this one purpose, we'll ignore that interest income. You will still be considered a person exclusively supplying goods. This is a critical exception you have to remember.
So we've talked about the limits, 10 lakhs, 20 lakhs, 40 lakhs. But what exactly goes into calculating this aggregate turnover? Let me tell you, this definition right here, this is where marks are made and this is where marks are lost. Get this right and you're golden.
Okay, let's break it down. The most important thing to remember is that aggregate turnover is calculated on an all-India PAN basis. You have to add up the turnover for all your business locations across the entire country. And look what's included. Not just your taxable sales, but also your exempt supplies and your exports. Everything gets added up. Now, what's excluded is just as important. You don't include the GST taxes you collect, and you don't include the value of inward supplies that you pay tax on under reverse charge.
Let me say that again, because this is a huge point of confusion. If you buy a service where you have to pay the GST yourself under reverse charge, that value is not part of your turnover. It's an expense for you, not a sale. It's the supplier's turnover, not yours. Do not make this mistake in the exam.
So, let's finally solve Arav's case. What did he have? He had taxable sales of 18 lakhs, and he had that interest income of 3 lakhs. Now, we know that interest is an exempt supply. So, what's his aggregate turnover? Well, we have to add them both up. We take his taxable supplies of 18 lakhs, and we add his exempt supplies of 3 lakhs, and that gives us a grand total of 21 lakh rupees.
And there we have it. The answer is clear. Arav's aggregate turnover is 21 lakhs. Since that is more than the general threshold of 20 lakhs, Arav is absolutely 100% liable to get registered for GST. It was that little bit of exempt income that pushed him over the edge. See how applying the definition perfectly gets you the right answer every time?
Okay, we're almost done. So far, we've only talked about registering because your turnover crossed the limit. But Section 22 has a few more tricks up its sleeve. There are some special situations where you have to register because of a specific event, and your turnover doesn't matter at all.
Let's quickly run through these. First, migration. This was a one-time thing back when GST started. If you were registered under the old laws like VAT or service tax, you automatically became liable under GST from day one. Next, business transfer. If you buy a whole business that's already up and running, what the law calls a going concern, then you, the new owner, have to register from the day you take over. And finally, amalgamations or demergers. Now, this one's a classic exam question. The new company has to register from a very specific date, the date the Registrar of Companies gives it a new certificate of incorporation, not any earlier date. And that, my friends, is Section 22 decoded. It just goes to show you that GST liability is about more than just a number. You have to look at the whole picture: turnover, definitions, and special events.
Imagine this. A business makes just one interstate sale of a taxable item for 500 rupees. That's it. Do they need to register for GST? Your gut might scream, no way, it's just 500 bucks. And boom, that's the trap. You see, in GST, the amount doesn't always matter. And by the end of this, you'll understand exactly why.
Okay, check this out. We've got two businesses. Biz A has a turnover of 15 lakhs. Biz B is doing much better at 35 lakhs. Now get this, under GST rules, Biz A, the smaller one, might need to register, while Biz B, the bigger one, might not. How on earth is that possible? Well, it's not about what's fair, it's all about the sneaky little details in the law. Let's dive in and figure this out.
Okay, first up is compulsory registration under Section 24. Think of this as the no turnover limit club. If you're on this list, your turnover just doesn't matter. It could be 40 lakhs, it could be 40 rupees. You absolutely, positively have to register. No exceptions.
So who's in this exclusive club? Well, first, anyone making an interstate taxable supply of goods. That's our 500 rupee seller from the start. Then you have casual taxable persons, or CTPs. Also, anyone who has to pay tax under reverse charge. Non-resident taxable persons, NRTPs, they're in too. And so are persons who have to deduct TDS under Section 51, like government departments. And finally, agents making taxable supplies for someone else, All these guys, straight to registration.
And the list continues. We've also got the Input Service Distributor, or ISD. Then the big one, e-commerce operators, and we're going to break that one down in just a second. You also have OIDAR service suppliers from outside India, and online money gaming suppliers, also from outside India. And of course, there's a catch-all for any other person the government decides to notify. For all of them, just forget about the turnover limit.
Okay, let's zoom in on e-commerce, because this is a total exam hotspot. First, the e-commerce platform itself. If it's collecting TCS or it's a notified service, it must register. That's simple. Now, what about the people selling on the platform? If you're supplying goods through an eco, registration is compulsory. But, and this is the classic ICAI twist, the threshold limit does apply if you're only making intrastate supplies. On the other hand, if you're supplying services through an eco, you get the benefit of the threshold limit of 20 or 10 lakhs. This difference between goods and services is where so many marks are lost, so pay attention to this one.
Now, a really important note for your CA Inter exams. You don't need to know the deep, dark secrets of what a CTP, NRTP, or OIDR supplier is. That's for the CA final level. For you guys, all you need to know is that if you see one of these names in a problem, your brain should immediately flash Section 24, compulsory registration. That's it. That's the key takeaway.
So we've just met everyone in Section 24 who must register. But GST is all about balance, right? So now we're going to flip the coin and look at Section 23. These are the people who are not liable to register at all. They get to skip the whole process no matter what.
Yep. Welcome to Section 23, the exempt list. For the people we're about to talk about, the entire registration process is just not applicable.
So who's on this special exempt list? Two main categories. First, anyone who is exclusively, and that word is key, exclusively engaged in supplying goods or services that are either wholly exempt from tax or are not taxable under GST at all. Think of Modern Oil supplying petrol, which isn't under GST, or a foundation providing charitable services, which are exempt. Second on the list is an agriculturist. But, and this is a huge but, only for the produce from the cultivation of their land. This is so important. An agriculturalist is exempt only for what they grow from the land. The second they start trading something else, even a small amount, the rules change completely.
So, who exactly counts as an agriculturist? Well, the law is very specific. It has to be an individual or a Hindu undivided family, an HUF, and they have to be cultivating the land either by themselves, with their family's help, or by using hired labor that is under their own personal supervision.
Let's look at this example with Deshbandhu. He supplies wheat that he grew for 32 lakhs. That part is exempt. But then he also starts trading puffed rice, which is a taxable supply, for 9 lakhs. The moment he does this, we have to look at his aggregate turnover. That means we add the exempt supply and the taxable supply together. So 32 loss 9 equals 41 lakhs. Since that's over the 40 lakh threshold, his exemption is gone. He now has to register. See how that works?
All right, now we get to the really interesting part, crucial government exemptions. These are special notifications that can actually override the compulsory registration rules. These are the exceptions to the rules, and you absolutely need to know them.
Okay, exemption number 1. This is for people who are only making supplies where the recipient has to pay tax under the reverse charge mechanism. So think of a goods transport agency like Money Car and Transporters. They don't need to register. But, and here comes the ICI trap, what about the person receiving the service? DeWalker Manufacturing, they must register, even if their turnover is tiny, because they're the ones liable to pay that tax. Don't get tripped up on that. Oh, and this little exemption doesn't apply if you're a supplier of metal scrap.
Just remember this number, 20 lakh rupees. This is a game changer for a very specific type of supply.
And here's where that 20 lakh figure comes in. This slide is critical. If Dola & Co., with a turnover of just 10 lakhs, supplies interstate goods, Section 24 kicks in and they must register. But if they supply interstate services, they are exempt from registration because their turnover is less than 20 lakhs. The government has given a special exemption here for interstate services. This is a huge point of confusion and a very common exam question. Goods are compulsory, services get the threshold. Got it?
Now, just when you thought all interstate goods were treated the same, there's another twist. The government has also provided an exemption for people making interstate supplies of certain handicraft goods and other notified products.
So how does this handicraft exemption work? Well, a few conditions apply.
your aggregate turnover can't go over 20 lakhs or 10 lakhs in special category states. You have to have a PAN card, and you must generate an e-way bill for your supplies. If you check all those boxes, you're good to go. So Ariza Private Limited, with its 15 lakh turnover of handicrafts, doesn't need to register yet, even though it's an interstate supply of goods.
And just a couple more things to tie up. That handicraft exemption, it also applies to casual taxable persons. And let's quickly recap the e-commerce rule for services. A person supplying services through an e-commerce operator also gets the benefit of the 20 or 10 lakh threshold as long as the operator isn't the one paying tax under Section 9, subsection 5. So, after all of this, what's the big takeaway? It's simple. When you're looking at a GST registration problem, the turnover figure is often a distraction. The real question, the one that gets you the marks, isn't what is your turnover. It's who are you and what do you supply. Answering that will lead you to the right section every time. So, picture this. You're in the exam hall. You get a question on GST registration, you nail the turnover calculation, you figure out the exact date the business became liable, you check the application deadline, everything seems perfect. But when the results come out, you lost marks on that question. Why? It's an incredibly common and frustrating scenario, and it almost always boils down to one tiny little detail that ICAI absolutely loves to exploit. So, to really get to the bottom of that trap, we're going to follow a single story throughout this whole explainer. Let's take a new business that hits the turnover threshold on the 25th of September. We're going to walk in their shoes, step by step, and figure out every single deadline and rule they have to follow. First things first, let's tackle the most fundamental question. Once your business becomes liable for registration, how long do you have to actually get it done? This is all laid out in Section 25, subsection 1.
And the rule on the surface is super simple. You've got 30 days. That's it, 30 days from the date you become liable. So for our business that crossed the threshold on September 25th, the countdown has begun. But listen, the deadline to apply is just one part of the puzzle. The real exam trap is coming up right now.
And this is it. This is the big one. It's not just about when you submit the application. It's about when your registration is legally effective. This one date dictates everything. When you can start issuing proper tax invoices, when you can start claiming input tax credit, everything. And if you get this wrong in a practical question, the whole thing goes sideways. This is exactly where marks are lost.
Okay, look at this. It's a tale of two taxpayers, really. On the left, you've got the person who does things right. They apply within that 30-day window. For them, the registration is backdated. It's effective right from the date they became liable. So for our case, September 25th. Perfect. But look at the right side. This is the person who messes up and applies late. For them, the effective date is the day the officer actually grants the certificate. Think about that. You could be liable on September 25th, but only get your certificate on, say, November 10th. For that entire gap, no tax invoices, no ITC, it's a huge disadvantage. This distinction is absolutely crucial.
Right, so we've got the main rule down pat. But you know how it is, especially with ICAI. They love the exceptions. So let's look at the special cases, because not everyone gets that simple 30-day window, and there are some non-negotiable ID requirements you need to know.
And here's a classic comparison they love to test. On one hand, you have your normal taxpayer, who gets 30 days after they become liable. But then you have these special characters, the casual taxable person, or CTP, and the non-resident taxable person, or NRTP. For them, the rule is flipped on its head. They have to register before they even start. The law says they need to apply at least 5 days prior to commencing their business. This is a very, very common MCQ trap.
Now, you'd think it's simple, right? One state, one GSTN. But of course, there are twists. First, if you have a unit inside a special economic zone, an SEZ, you must get a separate registration for it. No choice. It has to be treated as a completely different entity from your business outside the SEZ, even if it's in the same state. Second, if you have multiple business verticals in the same state, you have the option to take separate registrations. And third, if you're supplying from India's territorial waters, you register in the nearest coastal state.
And that brings us to a concept that is, and I cannot stress this enough, absolutely critical: distinct persons. ICAI is obsessed with this. Here's the deal. Whenever you have more than one GST IN, whether it's for branches in different states or for an SEZ unit in the same state, the law treats each registration as a completely separate person. So what does that mean? It means a stock transfer from your head office in Mumbai to your branch in Delhi is a taxable supply. Even though no money changed hands, GST applies. This concept is a goldmine for exam questions.
Okay, let's quickly talk about the paperwork, the IDs. What do you absolutely need? First, PAN is mandatory, period.
There's just one tiny exception. If you're someone who only needs to register to deduct TDS under Section 51, you can use your TAN instead. Second, Aadhaar authentication is now a must. For an individual, it's their own Aadhaar. For a company or firm, it's the CARTA, the managing director, or the partners. If you don't do this, the application is basically invalid right from the get-go.
And one last thing on identity numbers, and please do not mix these two up in the exam. A GSTIN is not the same as a UIN. A unique identity number is given to specific bodies, like a UN agency or a foreign embassy. Its purpose is not for them to pay tax, but for them to claim a refund of the GST they paid on things they bought here in India. Okay, we've covered the who, the why, and the when. Now let's get into the how. What does the actual step-by-step process of getting that registration certificate look like?
So here's how it plays out. You go online and submit your application. From that moment, a proper officer has 7 working days to look at it. If it's all good, boom, they grant you the registration. If they find a problem, they'll issue a notice. Then the ball is in your court. You get 7 working days to reply. Once you've replied, the officer gets another 7 working days to make the final call. Either approve it or reject it.
But what if the officer just doesn't do anything? They get your application, and then crickets. Well, the law has your back. This is called deemed registration under Section 26. If the officer fails to take any action within those prescribed 7 days, the system automatically approves your application. It's deemed to be granted. You don't have to chase anyone, it just happens.
Okay, pens down. This is a huge MCQ tip. Getting your registration certificate isn't the final step. There's one more piece of compliance. You have to furnish your bank account details, and the deadline is what they love to test. It's 30 days from the grant of registration or the due date of your first GSTR1, whichever is earlier. Remember that phrase, whichever is earlier.
All right, so you've got your registration. Fantastic. But business isn't static, right? Your address might change, you might add a new partner. Things happen. So what's the process for updating your details? That's where Section 28, Amendment of Registration, comes in.
Now, the government makes this pretty logical. They split your registration details into 2 baskets: core fields and non-core fields. Core fields are the really important things: your legal name, your main place of business, adding or removing directors. For these, you need the officer's approval, and you have to apply within 15 days of the change. But for everything else, the non-core stuff like your mobile number or email ID, you don't need anyone's permission. You can just log into the portal and update it yourself.
Okay, we're going to shift gears now and talk about something pretty serious: cancellation. This is a big deal, and since the consequences are so severe, you can bet that ICAI loves asking questions on it. This is all covered under Section 29.
So when can the tax officer come in and say, "Nope, we're canceling your registration"? Well, there are some big reasons, like getting your registration through fraud or issuing fake invoices. But honestly, the number one trigger, the one you absolutely have to remember, is just not filing your returns. For a regular taxpayer, if you miss filing for 6 months straight, you're on the chopping block. For a composition dealer or someone on the QRMP scheme, it's just 2 tax periods. This is the most common reason by far.
Now, they don't just cancel it overnight. When the officer starts the process, your registration first enters a kind of limbo called suspension. And trust me, you don't want to be here. Why? Because during suspension, your business is basically frozen. You cannot make any taxable supplies, which means you can't issue any tax invoices. You also can't file your returns. Everything comes to a grinding halt while they decide your fate.
Okay, so the worst has happened. The cancellation order is final. What's the damage? Because it's not just about stopping your business. There are big financial hits. And is there any way to undo it? Let's talk about the aftermath and revocation.
And here's the sting in the tail. All that input tax credit you happily claimed on your stock, your raw materials, your capital goods, the government wants it back. You have to pay an amount equal to the ITC you're holding in your closing stock on the day before the cancellation takes effect. This calculation is a really, really important part of this chapter.
So how do you calculate this? Well, it's different for inputs and capital goods. For inputs, you have to calculate 2 things: the ITC you originally took and the output tax you would pay if you sold those goods today. Whichever of those 2 amounts is higher, that's what you have to pay. For capital goods, it's a bit different. They assume a life of 5 years, or 60 months, for any asset. You have to pay back the ITC for the remaining life. So, if you bought a machine, claimed ITC, and used it for 20 months before cancellation, you have to reverse the ITC for the remaining 40 months. It's a proportionate reversal.
So, Is it completely game over? Not necessarily. If the officer canceled your registration, you have one last lifeline called revocation under Section 30. You have 30 days from when you receive the cancellation order to apply for it. The officer will look at your case. If the reason for cancellation was, say, not filing returns, and you've now filed all of them and paid your dues, the officer can revoke the cancellation. If they're not convinced, they have to at least give you a chance to explain yourself before they reject it.